Hi everyone, I'm Yogesh Shroff, your host for the Smart Alpha Show, where we discuss everything about financial markets. Today's topic is something which is talk of the town. Sorry, talk of the world. Indian IT, the most boring, predictable compounding machines on Dalal Street. TCS, Infosys, Wipro, companies that never gave you drama, just steady earnings, fat dividends, and decade-long wealth creation. Down 30 to 40% in weeks. So what just happened? Let me break it down for you. The market is pricing in a structural change in these companies. First, let me explain what the IT services model actually was. Instead of hiring in America, US companies would hire people in India and enjoy a cost arbitrage of 50 to 60%, paying salaries in INR for essentially the same work. The market believes the nature of that work was basic and repetitive. The basic thesis is that these entry-level, high-volume jobs are going to be wiped out by AI doing much of that work. Palantir, one of the largest AI services companies in the world, claims that SAP migrations, a large market, can now be executed in weeks instead of taking IT services companies years to complete. The software doing this work, AI agents, is far cheaper, far faster than human beings. The market believes IT services companies which used to do this work are no longer required, or their requirement is much lower than what it was earlier. But I would argue there are significant flaws in this theory. Enterprise level applications and services require precision, safety, and scalability that AI agents are still not capable of delivering. And now, let's talk about the history of transitions like this, because this is definitely not the first time something like this has happened. Every major platform shift in tech history, PCs, internet, smartphones, took 15 to 20 years to fully play out. Cloud migrations started in mid-2000s. We are still doing it. Enterprise tech stacks are not uniform. They're very unique to every company, every vertical. Banking infrastructure does not look like retail. Insurance doesn't look like manufacturing. You can't just drop an AI agent on top of 40 years of custom code and legacy ERP and call it done. Even with AI growing very fast, enterprise adoption remains low and will take multiple years to scale. These enterprises will need to modernize the systems and complete their cloud migrations, all of which create massive opportunities for IT services companies. And implementing AI systems is not something every company can do on its own. Core SaaS is not dying either. ServiceNow, Salesforce, SAP, they're all building their own AI and their AI agentic layers. ServiceNow says 90% of value on its AI platform stays with ServiceNow. OpenAI and Anthropic get 5 to 10%. The core monetization isn't going anywhere without fight. One very interesting thing that nobody is actually talking about is AI expanding opportunity for IT services firms. There are 800 billion lines of COBOL, a very old coding language, still running global financial infrastructure. Modernizing that alone is a $1.6 trillion opportunity. AI cuts the cost from $800 million per project to $200 million. It doesn't kill the services firms, it makes the projects actually viable. Hundreds of firms wanted to modernize but could not justify the cost or the timeline. Now suddenly it's more affordable and more companies want to do it. AI also increases cybersecurity risks, driving demand for enterprise security services. Every enterprise wants to customize its ecosystem around AI. Every factory now wants to build and integrate AI. These are entirely new categories that did not exist before. IT services was in a structural bull run for the last decade. These companies were growing at 8 to 10% annually but trading at a 25 to 30 times earnings. Fairly expensive. Now valuations are coming back to earth. Contract values will also shrink going forward. The era of multi-billion dollar contracts is fading. Contract sizes will be smaller but volumes will increase significantly, and firms won't need as many people to win or service them. Leaner workforces mean higher margins and lower cost. Honestly, I don't have a crystal ball in my hand to tell what exactly will happen, but I feel the current sell-off is way more exaggerated than it deserves to be. Ultimately, only time will tell how AI shapes up. Currently, people are expecting it to improve significantly, but I have a theory where 80% of the improvement or technology takes 20% of the time to build. The rest 20% is accuracy of AI, making sure it doesn't hallucinate. It scales properly and secure for enterprise use. This is a very long journey. Would love to know what you think in the comment box below. If you found this video valuable, It would mean a lot to us if you shared the video with someone who could benefit from it. Don't forget to like the video and subscribe to the channel so you don't miss on upcoming research and insights.